Alright, direct participation in programs, limited partnership. Direct Participation Programs Limited Partnership, Chapter 5. Direct Participation Program is an ownership and interest of the business for the permits of the owner to include both income businesses, the lost on the tax form, while intervening tax for the majority of tax shelters investment that are found in the oil, gas, real estate equipment, and the leasing within the section will cover the basic concept, characteristics, direct participation program, possible advantages for the investor to and from the investment is suitable. Please note Series 7 exam, direct participation program, limited partnership or simultaneous. Limited partnership is a syndicate group with approval for the joint venture for the non-corporate with the trust and estate with the review of the business with the carried out composed of at least one general part of the manager for the day of the data activity financial responsible for the unpaid debts. With the partnership in addition, there must be at least one limited partner for the share of the profits of the partnership with the most loss of the limited with the amount invested with the venture. Limited partnership provided taxes benefit of all the having all profits and losses throughout the individual partnership itself with the paying no tax with the personal tax return of the individual partner reflect activity limited partnership some of the but not all of the partnership registered for the Security Exchange Commission published for the prospectus of the remaining profile with the file now information Security Exchange usually require much of the large investment appropriate only for the more affluent and knowledgeable investors. Formation of limited partnership chartered with very much like a corporation V, but the shell with the public-private documents must be like the corporate charter is called certified limited partnership. It contains one business purpose of the partnership is identified with the partnership by name with the name and address within status of each of the general partner. Each limited partnership financing include contribution money property for the other contribution made with the circumstances and with the additional contribution made for the contribution made in return. Sharing arrangements, allocation of the expenses as well with the profit and income of the term of the partnership of life of the usual span of 10 years. The provision of change of the partnership would include interest of the partnership may be transferred and how with the understanding with the circumstance new partners may be admitted for the provision continuing to dissolve of the business in the event of the death of the general partner. The certificate of them must be signed by at least one general partner, one limited partner, filed with the one state with which of the partnership is organized. Certificate become with official with the day with the filed. There's a substantial change with the partner. Certificate must be amended with the reflect any error to discover the containment of amendments might be filled with 30 days change with the discovery with the error, perhaps organized with the shape of the must so to comply with the laws of the shape of the agreed limited partnership contract stipulated with the rights obligation limitation both general limited partnership. Agreement that may need not to be filed with the public. The subscription agreement is evidence of the purchase of the interest of limited partnership or limited partner and company name, the address, security, social security number for tax ID, number of limited partner for the document also contains limited partner statement. And if he or she is qualified with the net worth that he or she has read the prospectus, is familiar with it, also again accept the risk inherent with the nature of the partnership of the business and grants powers of the attorney of the general part or to act limited partner in matter of the partnership. The most important of the responsible registered representative to verify the limited partner financial qualified informed risk nature of the partnership business. Powers, obligation, limitations of general partners. General partners have the right to share with the rewards of the business spelled out within the detail of the partnership agreement. His obligation management of the business of the partnership to act as the fiduciary of the behalf of the limited partner for the best interest of the partnership. Limitation placed on the general partnership, sometimes called the sponsor or syndicate, with shed some light on some which with must have discharged his obligation. The general of the partner may never act in any of the way that would prevent the ordinary business of the partnership, may never buy, sell any asset of the partnership for any purpose of the partnership business, and never compete with partnership for personal gain. Special written permission of the partnership is required for the new general limited partner may be admitted with the partnership before partnership business may be continued with the death of retirement incompetency with another general partner before any compensation may be received with the partnership unspecified partnership agreement. In rare cases where the general partner must act with the partnership outside of the agreement, the limited partnership also forms permission called the parentship democracy for the created in case of legal action. An example, the notification judgment against the partnership is required of the partnership democracy before the general partner may accept the judgment acceptance of the contesting judgment. Word of obligation, limitation, limited partner with the right to share the profits outlined, certificate of limited partnership, the plus for the return of the capital contributions if the remaining when participant partnership to dissolve the access to the book of the records of the partnership, periodic information, partnership status of their own interest of the right to claim the general partner to dissolve a limited partnership in certain circumstances under limited partner may transfer owner interest of another person due to death, transfer limited partnership interest for the decreased partners of stage which now has all the rights and obligations of the owner of the partnership. Cause of dissolution of limited partnership agreement specified the date of the partnership to be dissolved. The partnership can be dissolved prior to the date with the majority voted for the limited partnership. So the partnership and asset of the debt of the incapacity of the general partnership and the life of the partnership. The agreement provides a replacement with an event with a limited partnership determinative of the response of the general of the partnership or report terminal state when the partnership is formed. So the limited partnership certificate may be canceled when the limited partnership is terminated. There was also distribution of assets of the file of senior secured creditors, general creditors, return investment, limited partners, general partners, distribution of profits. If the asset is not sufficient to meet the credit obligations of the partnership, it is responsible for the general partners to meet the debts. Federal tax qualification for the limited partners. When mentioned earlier, limited partnership and non-taxing paying entities as corporations are consequently limited partnership must differ from the corporation at least 2 or 6 fundamental characteristics in order to meet the basic federal tax qualifications. Limited partnership. Corporations have the 6 characteristics: engage business for profit, are association of 2 or more individuals, have central management, provide limited liability, have perpetual life, and are free and transferable. First, 2, the business with a profit of 2 or more associates unavoidable. Limited partnership with the secure of the 2 are precious. If they gave up the limited partnership, provide with a definite term of life, restrict transfer assets in which they were secure of themselves, the status of limited partnership. Federal tax treatment for the limited partner. For the detail of the tax payment they will pay on Series 7. However, there are numbers of the terms apply with the partnership and their taxation base of the partnership. The owner's adjusted purchase price, total cost compromised with a lump sum of the sum of cash contribution of the partnership plus a periodic contribution plus any of the recourse loans of the individual partnership responsible. Non-recourse loans, that is, the loans taken out with the partnership in which the partners are not personally responsible, may or may not be part of the space of taxes and advice is needed. Partner basis adjusted upward. Income less for the partnership by extra for the percentage depletion. Later term will be reviewed with the will to talk of the oil and gas programs, kind of the depletion allowance for the partner base for the adjusted downward for the distribution made with the partnership. As is, for example, the cash product paid out expense for that are not amortized depletion allowance for the losses crossover to describe the partnership that generates taxable income with the partners. For the example, the beginning income with the offer of say with the depreciation depletion. Later there is an excess of the income that becomes taxable. There is, for example, the crossover the phantom income that is taxable and not represented by any cash flow. For example, the partner gives away ownership to interest and in doing so reveals the debt. If the interest is debt relief, it is considered income of the IRS is taxable. The recapture refers to the fact of the premature sale of the partnership with interest that may cause certain deduction tax credit. Housing rehabilitation recapture is taxable income since these deductions were previously used the otherwise taxable income. This is quite tax burden over the owner. Tax advice is needed. Tax laws are quite specific about the basis continue with a negative number. Thus, any of the tax benefits banned with the partnership and interest are limited to the amount with at risk the basis. Alright, deduction, depreciation, and depletion of tax credits are foremost common tax benefits associated with a limited partnership. The deduction of the expense of the production income of the year, with the expense of the year, the depletion represent the intangible costs paid back with the over a period of time. Tax credits override deduction from the tax bill. At the present time, tax credits are limited to one rehabilitation, historic building, low-income housing. Deduction, the deduction of items include with the interest paid over during the tax year of the real estate, with the sales tax, professional fees, such as the attorneys, accountants. Fees must be included with the management, other fee of the general partnership, but such of them may be disallowed with the excess of the not unusual and necessary cost funding, mineral valuation, probably profitable mining efforts, naturally generally operating expenses. Some of the deduction of it cannot be taken into the year that they occur, but rather must be taken in a small piece for the amortized over the life of the venture for some of the other periods, such as the deduction prepaid interest in which for the next year interest paid the deductible in the year the following year is the same. So when the construction period of the tax, the same principle apply with however the table to determine the period over which these are amortized. Prepaid fees are amortized over the life of the term. Then they buy financing fees. Like points are amortized over the life of the loan as our loan standby of the loan commitment fee for the partnership organization fees, which does not include the commission cost of sales, are amortized over 60 months. Syndicate fees are expensive but cannot be deducted at all, but the commission and other costs of sales of the partnership, rent, and legal underwriting expense of the remaining of the part of the cost of the partnership, such as the reduced and taxable gain. Is there any? Those deductions, even the taken in the year of the occur at amortized reduced basis and shelf their all portion income in the limited partnership, the point at which the income from a limited partnership venture exceed with the deductible exceed expenses is called the crossover point. Depreciation is the count of the term describing the fact that a certain corporate assets simply wear out with the depreciation change with the deducted by both value of the assets on the balance sheet corresponding with the net income of the income statement. Here's a business that has at least $200,000 estimated life of the 10 years. The depreciation, straight line, fixed asset cost, depreciation, revenue, sale of cost goods, sales, depreciation, income before interest tax. In practice, the balance sheet entry will represent accumulated depreciation, that is, total depreciation since the asset was placed in use, whereas the income statements were represented only with the year of depreciation. However, the total annual depreciation listed on the income statement will total accumulated depreciation on the balance sheet. Tax reform of 1986 established with the two kinds of depreciation, straight line and accelerated cost recovery system. In general, straight line may be used with real estate with the other as permanent owners in either straight line or the accelerated cost removal recovery system. The amount over the time the method of the accelerated cost recovery system defined in the IRS, generally with the general security exam, does not probe it in such manner because they are terribly complex even for experts. Two things that should be noted: with the depreciation amount of the depreciable is to be no longer to be the scrap value. 100% of the cost of the non-depreciable land is never the depreciable term cost base. For the technical expression of the amount of the depreciable, for the example, the cost base of the acquisition fee for the developed real estate with start with the cost plus commission, the fee for the other acquisition charges minimum minus value of the land, which cannot be depreciated. The result cost based on would be depreciated on an annual straight line basis over the next 31 and a half years. Accelerated cost recovery system time for real estate is 31.5 years. Depletion. Natural resources such as coal, oil, timber, and so they do not wear out, but these get used up. The accounting of the term to describe the value of the resource of the depletion. Depletion allows the tax account method of providing systematic deduction for the decreasing the value of the asset, like mine or well, while minerals from it are being used up. There are two ways of computing depletion cost: depletion percentage, depletion cost of depletion. Very simple. The permits owners to deduct portion of the money received from the sale of the product. For example, the entire cost is recovered. Percentage depletion is and more complex under the accounting method of the possible recoup more than the original cost. The excessive percentage depletion is added back to the cost of the program. It's obvious percentage depletion is more advantageous than cost depletion. However, it is only permitted in new oil programs. It is not permitted to own if the partnership also refines or markets the oil products. It's only permitted on small wells, those with less than 1,000 barrels oil per day. Real estate limited partnership. The most real estate partnerships are responsible to develop the broker who become with a general partner. The compensated with the commission of the management fee for the other money associated with the management of the property with the partnership. The main invest with the variety of the property with residential apartments, duplexes, etc. with the commercial office buildings, warehouses, shopping centers. Larger partnerships usually have the portfolio buildings, sometimes because of both residential and commercial investors enter with a real estate limited partnership for a few basic reasons: the diverse sum of the investment capital into the area with the other stocks and bonds, persuade and benefit owning of the kind of the real estate, but neither of the capital nor the business, the accruement of the purchase of the operate their own, no shelter from tax. The typical limited partnership that goes through the life cycle will last for the 4 to 10 years, although there are hard and fast rules on this. The typical partnership goes through the cycle of the sponsor raises the capital with the investor of the partnership that is formally established with the sponsor with the general partner of the investor limited partner. General partner purchases one or more buildings and operates them on the behalf of the partnership. When many of the tax benefits have been used up, when the buildings have appreciated significantly, the general partner will sell the property with the distributed proceedings according to the agreed upon form of the partnership. That ends at this point, generally with the return of the investor income to the force of the cash distribution, tax benefit, property appreciation, reduction in mortgage. Every partnership has a different objective that will stress one of the sources of the benefits more than the others. Cash distribution. Limited partnerships may buy existing income property with the tenants already in place, usually with generate with the cash distribution. After collecting the rents, making the payments for the taxes, utility maintenance, and the mortgage of the property, may have fund left over the payout with the directly limited partners. Tax benefit. Like other business enterprise, the operator of the real estate may deduct the cost of the operation from the revenue determined with the taxable income. Of the deductions include cash expense like mortgage, interest rate, salaries to building managers, maintenance expense for the taxes. They must include with the non-cash expense with the depreciation. The depreciation deduction very often result of the real estate operation showing loss for the tax purpose will still have the cash distributed with the partner. The partners can also use the loss of the shelter sum of their own income. Property appreciation. During the life of the partnership properties, this might increase the resale value because of the inflation improvement of the building and the good management of all three. Reduction of mortgage loans. The most mortgages of the property are structured to each monthly payment to pay interest and the part repayment of the loan principal at 5 to 10 years of the mortgage payment. The limited partnership that has increased the equity of the property to considerable extent. All investment carry the risk. Real estate tax shelters can experience problems due to the interest rate changes, poor occupancy level, the cost of operation change, and the tax code. The key success of the ability to the general partner to buy the right and manage the right and sell the right. Real estate programs offer the wide range of the benefits, including tax saving the price of the depreciation income of each of the program consists of its own combination of risk elements, which over the add of the degree of the risk. New construction programs provide greater appreciation potential. Some of the potential for the taxing with a level, no potential for income that do not qualify for the special category tax saving. The elements of the risk include the cost overruns, construction delays, location risk, zoning, the negotiation risk period of no income. If over the risk or avoided with depreciation potential may be enormous. Existing property provides some of the potential for the tax saving, the income and appreciation and existing of the property of the tax saving. They arrive the investing tax credit, the rehabilitation of the old and historic buildings, income potential for the rent, the appreciation potential from the gain in value of the characterized real estate over the past year of the existing property without generally complying with the vacancies, lease tax restrictions, zoning, and regulatory risk. Government-assisted housing provides little or no income and appreciation potential, provides stable, sizable tax savings. The savings over the result of the higher leverage and multiple write-offs command with a special schedule for the accelerated depreciation, less risk with the recapture, whether risk of the government policy tax laws may change if there is the reducible risk of the audit by IRS, sales and leasebacks. Many real estate programs begin with the sale of the property with a partnership with these leasebacks to the sale of the arrangement. It's called the leaseback with the seller and the leaser occupies the property. The seller and the leaser rents the other arrangement. It's called the operative leaseback, but usually contract with in either case of the triple rent lease. That is the lease in which the leaser is responsible for the property tax, the insurance, the premium for the maintenance cost, the benefit of the seller and leaser in such arrangement may include liquidity from selling, resulting improvement of the balance sheet, as well as the ability to deduct the rent as all operating expense. They trade for the obligation represented with a long-term lease, loss any appreciation value of the property buyer, lesser benefits of the depreciation, interest, the deduction, any of the financing enables with the distributed cash tax-free with the early sale of the lease itself, the quality of the tenant provided with the ease. Financing in many cases also represent with a greater risk default of depreciation potential as Russell retired a long-term lease. Condominiums security. Condominiums may be class regulated securities if their investment intent with a part of the management is conducted by a third party or rent pool, if the roster exists on the rental for the unit. A direct investment rather than a partnership in interest with the condominiums are evidence of the following documents. Master deed with establishes the project as a whole, whether its purpose of the defined units of the common area of the cost sharing agreement, the type of the management by laws describe the management, proceed with how members are elected, the limits of their authority, the regulations, established rules, occupancy, such restrictions, children, animals, noise, purchase sale agreement, the defined terms and sale, what unit price, what price, and how financed, rental agreement established for the rental management fee, the restriction owners, use of the property if the owner of the condominium has residence for more than greater than 14 days or 10% of the number of days is rented, but the IRS may declare it as the residence. Owner may lose the right to claim interest and depreciation as a business deduction. Unit deeds are defined with the buyer owns the unit, the space to be shared with the other investors over the what terms. Benefit of the condominium securities include the tax with the form of the deduction, depreciation, management fees, interest, operating expense, the income may result from the rental, but in most cases the subordinate appreciation potential, which would be significant risk and should include erosion and erosion, property value, cost management, possible loss of business statute, and venture of the closed hobby. The IRS tax savings is disallowed. Raw land provides no tax relief, no income is held largely at appreciation potential, but they usually generates negative cash flow for the form of the property tax because it contains more uncertainties for fewer immediate rewards than other ventures and considerably higher respective of the risk. Alright, oil and gas programs. Oil and gas is a limited partnership gain profit from popularity. Investors oil and gas prices increased sharply with the mid-1970s. The enthusiasm for investment, but it damped lightly respond with the softening of the price of oil, still owing the long-term nature of the oil gas venture for these participants. Partnerships may be the excellent investments for some of the individual oil gas partnerships. You will take one of the following forms: drilling program, the drilling number of the test wells, holding the hope of discovering a commercial viable resource. Income program, the buy rights to prove and producing wells. Over the other type of the drilling program was most popular with it despite higher risk. Register of the drilling programs became available to small investors in the 1960s with a minimum investment from $5,000 to $10,000. These programs are usually sponsored by the operating oil companies, which act as the general partner. Once the sponsor or even the large pool with the capital with limited partner, the typical will expend the capital over the 1 or 2 year period over the number of the test wells. Test wells will provide productive give partnership and stream of income over the life of the wells, which may be 10 to 25 years. There are different types of the drilling partnerships. Explanatory partnerships are wild cat venture with explorer with the new field with these risk forms of the drilling. Most professional and profitable have a development partnership concentrated these wells adjacent to the areas proven reservoirs reserves. These are least risky and also least rewarding. Balanced partnerships due for the exploratory development drilling. Limited partnership drillings look to the two sources of the investment benefit of the extent of the depends on the staff of the test well with good management practices by the general partnership. Tax deduction of the investor capital will expand within the way that allows the individual limited partner to deduct most of the investment from the personal taxable income over the first 2 years. The tax advantage income of the one income sales of oil and gas is not fully taxed due to the oil depreciation allowance. Oil and gas programs also potential application income tax saving. Explanatory programs provide tax savings if the ITC of the accessible may provide with the income shelter depletion allowance larger potential appreciation. There are in sense wildcatters with drill with the new discover the extent of the existing field with high initial expense dry hold long delays before return recapture of the investor depreciation costs and upon sale of the risk of the such program phase development programs seek to add proven reach over the existing field will provide benefits of tax relief of the investor depreciation cost with good probability income sheltered partially by the depletion allowance the risk of the high base cost of delays before return recapture of the investor's depreciation costs on sales. Income programs sell out gas from the property of the bought or at least provided as benefits income partially sheltered, but because they do not drill, there is little or no tax saving and little appreciation potential. Thus, the price of the natural resource rises the lower sky, largely an inaccurate estimate. Proven reserves or subsequent overpriced leases or properties. Combined balance program structures themselves with a percentage exploratory development income provided with a mixed benefit the risk suited to the particular set of objectives. Allocating cost revenue sharing and arrangement, the method of the dividing cost, the profits of the will be incentive for limited partnership, the risk capital of the general partners, the stated partnership, the interest is one of the general partners pay all the parts of the expenses, more usually carried interest in which someone else with limited partnership pays the leave for the purchase price for the property for the expense of the exploration production. The overriding of the royalty interest is carried interest for the general partner sponsor, but it takes about 1/8 to 1/16 of the revenue off the top overriding royalty, leaving the rest of the limited partnership as an expense. And revisionary work interest also carried interest. Limited partners recover expense for the distribution 1/8 to 1/16 of the general partner. All revenues revert to the limited partner. Net operating profits and interest carried also for the production expense for deducted for the gross revenues before anything goes to the general partner. The remainder of the course goes to the limited partner. This proportionate sharing interest is purchased normally 25% of the cost of the program, disproportionate because of the general partner takes 50% of the revenue. Functional allocation general partner is non-deductible cost of organization partnership capitalized amortized costs like cease of the equipment and 1% of the IDC limited partnership and 99 IDC half operating costs is split usually 40-60 or 50-50 with the revenues. General partners receive a large portion of limited partners, however, get all the juicy tax savings while they're sharing income and capital appreciation. Alright, equipment leasing programs. In the past, equipment leasing programs have been popular where there is need for the equipment to win over the economically more advantage for the company to lease rather than buy it. Equipment, almost all of the formative equipment have been subject to the leasing agreements and beyond with the scope of the supplement of the concentrate of the region. The companies choose the lease. Sure, they save capital costs for the equipment spread out with the lease for the payments over the time of the headaches of ownership of the buyer lease for the equipment that does not does so because the cash flow is partially stuck, shelf with the depreciation cash and cash return high because there is residual value of the equipment partially totally in some case for the recoup of the cost of the equipment except for the technology obsolescence for the brand new computer technology makes other computers obsolete. Equipment leasing is generally not high risk. Of course, it's important in limited partnerships on equipment leasing that have general partnership to right lease for the failure to do so may result in the cost efficiency and inadequate leasing other situation income of the partnership right lease if it is not obtained, but there is also a danger of default idle use of periods of obsolescence to term in conjunction with equipment leasing. Full payout lease of the total lease of the net lease of the lease of the lesser of the all operating of the total payments equal to the exceed of the cost of the equipment plus financing obvious. Such lease agreement has little risk totally with recoups the cost and provides minimum income. Operating lease there a short period of time one over and one half of the less of the expected life of the equipment. Leave the owner and less of the risk of the re-rental of the resale of the equipment inside of the salvage value of the cash flow for the higher and depreciation accelerated right is higher but there is added risk. Factors in evaluating economic soundness of partnership can venture produce gains and incomes assets of the land rights equipment fairly prices financing adequate to consider the debt resource for the non-resource installment abatements assessment voluntary mandatory letters of credit general partnership hounds capable to consider his or her business history track record success capability financial soundness. How are the other programs done? We touched on the major vehicle for the tech shelf of the limited partnerships and investment. Many opportunities exist for the recent with the cable TV industry provides outlets for the limited partnership growth of the industry with the requirement of substantial capital investment. Limited partnership would be expected to provide such much of the capital exchange for the tax saving available to depreciation tax credit. Conflicts of interest with the general partners adjacent leases that may be held with the general partner indicating exploitation of the field expense of the partnership, commingle in partnership the field partnership with the other funds, especially those general partner, bad business, lending and borrowing between the partnership and the general partnership of the partner should be fair with the reasonable and not favorable to the general partner. Finally, because the general partner handled the day-to-day management, he or she would probably receive some and then with a good performance during the portion of the program at the liquidation termination. However, the most of the program that defers return to the general partner until the sum of the return is realized with the limited partner. Evaluated returning of the program either the cash-on-cash return hurdle rate of the return normally used. Cash-on-cash simply divides dollars received by dollars. Thus, the internal rate of return is slightly more accurate or complicated because it takes into account the time value of the money. Investor selection and program. Investors should be sure expensive partnership would conserve the abuse of which could cover the tax benefit that be disallowed. Investors should understand the obligation committed funds initially as well as any of the installment, the stage payments, assessment, all of the debt, recourse, and non-recourse, as well as the letters of credit. Investors need to understand the term of the commitment, the relative liquidity of the investment, of the well risk of the loss of the entire principal, the nature projection concerning income changing in tax, law increased risk of audit. Investors need to assess the risk when they get into their research of the objective light of the current future tax and their understanding of the venture. Alright, Security Investor Protection Act of the SIP. Later in the 1960s, securities industry began experiencing internal problems that had not existed with the Great Depression in 1929. Security firms found themselves with financial difficulties made failed. Customers needed firms who had cash balance security positions of the firms were subject to losses in an effort to protect the client of the New York Stock Exchange set up the fund to provide protection customer troubled firms. All New York Stock Exchange members were assessed the monies used with the partially identified customers. The conditions worsened the funds was discontinued, expended amount was estimated at $120 million. In 1970, the Congress passed the Security Investor Protection Act that established the Security Investor Protection Corporation. Security Investor Protection Corporation of the U.S. government agency federally chartered the non-profit corporation purpose to provide protection for the account, customer, and broker dealers that become insolvent. All broker dealers, except for the bank dealers, must become members of the Security Investor Protection Corporation, must display evidence. Membership in each office of the Security Investor Protection Corporation came into the beginning of all members' success based on their gross revenues until the fund had a total $150 million. The Securities Investor Protection Corporation also had a line of credit in the U.S. Treasury of $1 billion should the funds itself prove to be inadequate. Should a Security Investor Protection Corporation member firm fail, the trustee or sent with a handle with the liquidation value to determine the day when the trustee arrived. For instance, the client account that contained 100 share of the telephone AT&T, which traded at $65 at the value of the day, was viewed with the determined client's protection. Client received the distribution sometime later. The stock may be trading much higher than much lower price than $65 value would be used. Creditors given 6 months to present their claims after the trustee will begin the distribution. Security Investment Protection Corporation protects clients a maximum of $500,000 per customer. No more than $100,000 can be applied within cash balances. So if client Jones had $500,000 security in his account, it would fully be protected by the Security Investor Protection Corporation. Clearing Smith a $500,000 credit account, and an account should be protected only at a maximum of $100,000. Client Brown has $250,000 security, $250,000 in cash in his account. He would receive the maximum protection under Security Investor Protection of $350,000, $250,000 security value, and $100,000 cash. Should the client have an account with a value of excess of $500,000, she would become a general creditor of the firm. She must recover more than $500,000 from other sources, but not from the Security Investor Protection Corporation. Security Investor Protection Corporation covers per customer per account. John Jones may well have a cash account, margin account, income account. Total coverage is limited at $500,000. Mary Smith have portions account separately designated account as A account, B account, C account, so on, but she is one individual. Her protection will not exceed $500,000. However, Fred Brown, individual account, his wife Ruth, individual account, they have a joint account. Each would separately be covered in the Security Investment Protection Corporation to $500,000 maximum. As the organization of Security Investor Protection Corporation commodity accounts receive no protection, commodities are not considered securities under this definition. Taxation changes the IRA rules. Regulatory change, economic growth, the Tax Relief Reconsolidation Act 2001 changed many of the rules of the IRA. However, changed the Maximum contribution traditional IRAs. Both IRAs were increased to $2,000, $3,000 for 2004, 2005 through 2007. Increase of $4,000 in years 2008. Thereafter, maximum contribution $5,000 for people over 50. Additional IRA contribution may be made. Additional contribution referred to catch up through years 2004. Extra $500 may be added to total contribution of $3,500 catch up account in 2005 remains at $500 plus maximum contribution $4,000 total contribution. For years 2006, 2007, the catch-up increase of $1,000 for the total contribution of $5,000 for 2 years. 2008, thereafter, catch-up is $1,000 for total contribution of $6,000. Separate 5-year holding period established for the traditional IRA. Both IRA conversions, separate 5-year holding period apply with respect to the portion of the distribution properly eligible with the traditional IRA. Both RA conversion of the portion of distribution 5-year period to start year in which the conversion contribution was made, which may be divided with the year of which both first RA contribution was made. Even though the distribution amounts are attributed to the conversion may be subject to the income tax, they are subject to the 10% penalty tax if made during a 5-year holding period. 5-year holding period Roth IRA distribution. In order for the Roth IRA distribution, qualified distribution, you must have held the Roth IRA for at least 5 years prior to the distribution. 5-year holding period generally measured cutting 5 years beginning earlier with the first year from which the first regular IRA contribution relieved, not necessarily a year with the first regular both Roth IRA contribution made, first year in which you made a conversion contribution. Individual retirement accounts. Keeping above change of the mind, the individual will receive the compensation in the form of the wages, salaries, professional fees. Compensation may open an individual retirement account excluded with the contribution dividends, entry for the capital gains. Individuals covered in an employer retirement plan not permitted to have an individual retirement account. Maximum contribution $3,000 or 100% annual compensation, which is lesser. See above catch-up provision. Contribution excessive limit of 6% penalty change for the excess addition, except for the non-taxable deduct income earned not deferred. Individuals not covered a qualified retirement plan. Traditional IRA contributions are deductible for current income. For individuals covered retirement plan, IRS has established limited to the amount with it may be deducted for the actual amounts. Are not tested on Series 7 exam. Just be aware that there is a certain amount of the income exceed the amount they can deduct for the income that are reduced until they're no longer deducted. Husband and wives are both employed. They have 2 separate IRAs. You have the maximum contribution event of the file. Joint return maximum deduction $8,000 per year allowed. Catch-up provisions are also permitted. If one or both individuals are covered in qualified retirement plan, some of the restrictions mentioned in the preceding paragraph apply. Should individuals have the non-working spouse, husband, or wife, the individual may contribute additional $4,000 separate account with the behalf of the spouse, so they can catch-up provision apply. Contribution must be made in cash, may be deposited as late as April 15th for the previous year. The IRA may be opened in a bank with a mutual fund company. The brokerage firm will be acting as the custodian for the investment. Keep it in mind with the bank and the mutual fund company, the brokerage firm, and only safekeeping it for your investment. Owner of the IRA determines the investment, which is in the stock bonds of the investment companies, REITs, and annual annuities for such as the artwork, stamp collection, collectible, and not permitted edition. Investments must be paid for in full with the margin accounts are not permitted. Consequently, there is no short selling IRAs, investment contribution tax deferred or units until the distributed contributions are made. The IRA funds in the IRA may be distributed without penalty, starting with a 59.5. Must start with a withdrawal on April 1st of the following year if the owner reaches age of 70.5. The amount must be distributed the year of the determined IRS based on the owner's life, the expected life expected with the determined IRS as well. Early withdrawal of the IRA subject to the 10% made addition with the tax to be paid with the IRS will allow the early distribution under certain conditions, death, income penalty with the IRA owner, certain medical expenses, higher education expenses, purchase of first-time home. The owner of the IRA may transfer his or her investment retirement plan to another non-taxable transfer. Goes from an institution to the other. Owner withdrawal of investment, reinvestment of the other institution is carried out with a transaction known as rollover opposed to the transfer. With no restriction of the number of the transfer, rollover may be done every 12 months. An additional rollover must be done in 60 days. Both Roth IRAs contributions to the Roth IRA are not deductible income tax purposes. However, the earning contribution of Roth IRAs with cumulative tax deferred basis may ultimately be tax-free and earnings part of the qualified distribution. Qualified distribution made every 5-year holding period made at age 59. After age 59.5 with disability or for a list for the first 10,000 qualified first-time home purchase, the contribution Roth IRA has same traditional IRA as well as over the catch-up provision, the spouse provision, mandatory withdrawals. Age 70.5 does not apply. Simplified employee pension plans. Simplified employee pension plans, qualified retirement plan, World Simplified says all of the originally designated small business owners, employees owned for their own IRAs, the employer that make contribution on their behalf of the employers make with the contribution into the same account with the employers must include all employees that have worked there 3 or 5 last 5 years, earn at least $450 adjusted the cost of living area at least 21 years of age. The maximum amount of the employer may contribute to 25% of the employee's salary with a cap of $41,000 for 2004 employees fully vested in full amount. Education IRA covered dealt with the education saving account. Originally, the education IRA was not required retirement account. Consequently, the name was changed for the better identity of the purpose known as the Coverdell Education Saving Account, with a design to save money for the child's education. Individuals may contribute after taxes $2,000 for the children under age 18, depending on the income of the owner. The definition of accumulation for the tax rate of the funds used for higher education. Other type of the retirement plans can be broken down into two categories: qualified and non-qualified. Qualified is one with a contribution tax due for the fact that the plans meet with the requirements set forth in the Employment and Retirement Income Security Act of the 1974 and various IRS rules. Tax 1 on accumulation is deferred until the withdrawal and usually lower tax rate of since income than normally lower retirement edition of the plan. We do not discriminate with the means of the plan. Generally for a full-time employee with the assessment plan are held to the trust. Any withdrawals are tax ordinary income. Defined contribution plan provides an individual account with each of the participation benefit based on the amount contributed to also affect the income and expense for the gains lost for 2004. The annual contribution to the defined contribution plan cannot exceed smaller $41,000 of 100% of the participation compensation. Employer may deduct up to $25,000 eligible compensation each plan participant. Some type of defined contribution plans include 401k, 403b plans, employee stock ownership plans, and profit sharing plans. The defined benefit plan promises participants specific monthly benefit of retirement, may specify the exact dollar amount. Monthly benefits could also be calculated through formula considering the participant's salary years of service. One type of qualified plan profit sharing. The plan always allows employees to share profits with the company amount, but the contribution of the employer will vary from the company to company. 401 company may allow employees percentage of the salary before tax. Employers may match contribution various percentages according to the plan. Employees' contribution with respect to vesting again verified according to the plan. However, the employee contribution fully vested immediately. Normally, the employee is provided a menu of investment options to invest, ranging in the speculative with a conservative mixture in between. Employee stock ownership. In this plan, with the employee invests in the stock of his or her employer, the employer receives a tax deduction based on the market value of the stock without cash outlay. Many of the employees suffered a substantial loss in their plans in early 2000. 403b plans is similar to the 401k, but is available to employees with nonprofit organizations such as approved charitable organizations, church fraternal organizations approved under Section 501c3, sometimes referred to as tax-sheltered annuity. Tax-deferred annuity contributions are deducted in section income. Section 529 plans is not a retirement plan, but a savings plan to meet most high school with educational needs like educational IRA, covered education savings account. Contributions are made with after taxes. Some of the plans for a deduction from state taxes. These are state-run plans, vary from state to state, but as now that exist previously described by the IRA. Both IRAs, COHOG, HR 10 plans, and SCPs are all qualified. Non-qualified plan is also the exact opposite of the qualified plan in all respect. The contribution of non-tax deductible plan does not meet the standard of the EI or ERISA can discriminate, which usually means the plan is designated to take care of a highly paid executive. Addition of the plan is usually not established with the trust. For compensation plans, not qualified plan, the plan employee agrees to defer receipt of the current income favor payment of the retirement. The PayPal professional ball player of the top executives and assumes that the person will be in lower tax bracket than the retirement payroll deduction pay plan. If it's an unqualified plan, employees allow the employer to deduct a specific amount of after tax. The deducted amount may be invested in a number of investments, such as mutual and life insurance variable annuities. Alright, taxation.